It's Saturday, February 12th, and if you stick around, I'll show you some invaluable information about how to judge the risk of your account and see if you can manage that in your portfolio. So first, I'm going to explore some things that you can find just in your average broker like Robinhood, and then I'm going to take to the websites and look at a couple other statistics to help you determine how risky something is, how risk is measured, or to help you kind of judge the risk profile of your account. So first, we're going into Robinhood app. This is the desktop version. At the very bottom here, you're going to find these three. The margin requirement. It shows volatility, initial requirement, and maintenance requirement. So the volatility is important because it tells you if it's a very volatile instrument. The more volatile it is, the riskier it is. Okay. Initial requirements, the lowest is 50%, and it could be more than 50, and the lowest maintenance requirements 25. So the lower, the safer. Now, this judgment has been made by Robinhood themselves. It's not something it's not a judgment of your own, okay? But there are other metrics to try to figure out how risky something is. One of the metrics that you could use is just the size of whatever you're trading. So, for example, this is VOO, a very popular exchange-traded fund that many people invest their money in. So total asset under management, the AUM up at the top is $278.19 billion. So that's quite a bit. And so this makes this instrument fairly safe because it's such a large instrument, it's very liquid, and the chances that everybody's going to exit at once without any bids underneath to stop the decline is very slim. Let's take a look at something like, you can also take a look at the volume, okay? On the top right, average volume is 7.71 million. That's probably shares traded per day, which is good enough. Okay, now let's take a look at another brief example. How about the biggest company in the world, basically, Apple. And Apple right now has a market cap of $2.82 trillion. So it's quite a lot. Okay, so it's a very large company. You can see the average volume on the top right is 86.6 million shares traded per day. It's quite substantial, so that means it's very liquid. Okay, if it's large, there's a lot of shares outstanding and there are many shares being traded. That means its liquidity is very high. So those are just some of the measures. And if you want to look for entertainment, underneath you'll see that the volatility should be listed as low, the margin requirement should be at 50%, and the margin maintenance should be 25. Okay, let's find it. Okay, there we go. It's at the very bottom. So volatility low. Buying power, it's irrelevant, that's my money, or actually Robinhood's money. Initial requirements 50% and maintenance requirement is 25. So those are just some things you can just do on the Robinhood site itself. However, you could go on different sites. So this, for example, is Finviz, and if we scroll to the right here, you'll see something called the ATR. It's a little bit below Beta on the right. So an ATR is basically an adjusted trading average true range, okay? It's average true range. So what that means basically is depending on the time period that they've picked, maybe it's a day, maybe it's a week or a year. I don't know what this ATR is at the moment, but how much the price moves on average in a day from one point to the other. Maybe it's measured from the all-time high of the day to all-time low, or the beginning to the end. So I'm not sure actually how this one is measured, but it's one thing you can use to try to figure out how volatile something is from day to day. The beta is actually also a useful indicator. Beta just means the correlation between the asset that you're trying to trade or own and the S&P 500 basically. So if it's a 1, it's a perfect correlation. If it's higher, that means it moves more than the market up and down, and it's not as correlated in a volatile way. But if it's less than 1, that means it's not correlated. It's like it moves less than the S&P 500 basically. So 1 is perfect correlation. Now there are other ways that you can try to de-risk the account. Okay, not just figure out how risky whatever you're owning is, but whether or not it's in the same asset class as everything else that you own. So for that, we're going to go to some asset class definitions here. These are some of the most popular asset classes. So we have cash. Let's take US dollars for example, or perhaps you want to keep your cash in euros. There are many different types of cash that you can have. It's considered a fairly safe, one of the safest positions you can have. However, it reduce in purchasing power over time. That's called inflation, and the inflation rate in different currencies is different. So for example, the South African rand may depreciate at a different rate than the US dollar. So it's very safe, but it does depreciate over time. Then we have equity. It even has some examples up top above cash. It could be liquid funds, like the funds you have in your checking account or your saving account, in your wallets, or hard cash that you might carry underneath your mattress. The next asset class is equities. So the definition they have here is startup funding, index funds, ETFs, equity funds, and stocks. So those are basically part ownership of businesses, whether it's private or public. You just own a piece of a business. Even if you own your own business, that means you have 100% equity in your own business. Then we have fixed income. Those are usually like bonds, any kind of debt that you may be investing in. It says here you have a recurring deposit, fixed deposits, debt funds, EPF, PPF, NSC, or bonds. So basically any kind of lending, okay, that you might invest in. You give money to somebody, they give you back interest plus the principal at the end of it all, at the end of the period, the specified period. Then we have real estate. The examples they have here is REITs and property. Now REIT means real estate investment trust, and property is just actual physical property you might own the rights to, in whatever you live, like an actual house or a building of some sort, and maybe land. So that's also an asset class. It's also considered very safe. All of these are very safe with the exception of equities and the last one, which is commodities. Examples they have here are silver, gold, crude oil, and copper. But it can be really anything that can be tradable, and it's a raw good. Okay, it doesn't have to be a metal. It could be like orange juice, or lean hogs, or you name it, coconut oil, I don't know, wheat, soybeans, right? Most of these commodities are actually traded on commodities future exchanges, so which is a very, very big market, and there are actually people that make their living on these exchanges, selling and buying insurance for these crops in the form of futures, these commodities, excuse me. So those are kind of the main asset classes, and some would argue that crypto is a new asset class now, and digital goods like NFTs or whatever. So you can include that too if you want to. And one way to reduce risk in your account is to diversify in different asset classes. So for example, if you really want to make the safest account possible with the least amount of risk, then you would have equal parts cash, equities, fixed income, real estate and commodities, and in each one of those sectors, you would just buy the ETF, right? You'd buy the top largest companies or commodities traded or largest real estate, trusts, and just buy a basket of each one of those asset classes, and that would reduce your portfolio risk to probably the smallest degree possible. So, however, with that reduction in risk doesn't come much gain, right? The bonds are going to pay very little. The equity is going to pay a little bit, but you're probably going to have an ETF which is very stable and has like a 1.2% or so income through dividends, and maybe some through asset appreciation over the long period of time. And then cash doesn't give anything, right? It reduces its value over time, so that kind of offsets the bonds. And in fact, inflation rate right now is actually higher than the interest rates you can get on bonds. So bonds plus cash, you're actually getting purchasing power taken away from you. So that's 40% of your account is losing money, basically losing value. And the other three are gaining, but not enough to offset perhaps. Real estate is pretty stable. It's been climbing over the long term, especially if you buy baskets of some of the top real estate trusts. However, you must know that real estate is unequal, right? So if you buy individual properties, they may or may not appreciate over a long period of time, right? If you buy it, especially in some kind of jurisdiction that's got a lot of political risk or a waning economy, then your property value might actually go down even throughout the course of your entire life. And commodities have actually been in a downtrend in real value over a long period of time. Perhaps even gold, which is considered one of the safest commodities. It's been a store of value for many, many years, many thousands of years, and will continue to be a store of value as long as we live. So it's very safe, but also it doesn't give you anything, right? It's not a very good investment if you were looking to get a return. So spreading throughout these asset classes, you will preserve your wealth. However, you're probably not going to gain much either. In order to gain, you have to try to take risks somewhere. Some of the ways that you can increase risk is you can put your cash in other currencies that you think will appreciate relative to the dollar. So that's a risky bet. Perhaps you want to put some money into the Japanese yen or the Swiss franc or some commodity currency like the New Zealand dollar or the Australian dollar, and you're basically making a bet that it will appreciate relative to the dollar. So that's kind of like currency trading, right? You can also sell swaps to try to get some return on that. Same thing with equities. You can try to diversify from the S&P 500, for example, and maybe buy individual stocks or groups of stocks that you think, like sectors, that you think might outperform the S&P 500. For example, technology has been doing very well in the last 10-20 years relative to the overall market. So perhaps you want to buy a basket of technology stocks, or even if you want to go further, you could risk and buy individual names, like one or two names that you think will outperform everybody else. So you are taking a bigger risk. However, the potential returns increase theoretically as the amount of risk you take increases as well. Fixed income, you can make some money there as well. You could you could sell swaps in any of these things, basically options on any of these asset classes, by the way, including cash, right? So fixed income, same story. You could try to also go international. Some countries have a much higher interest rates. However, you have to take into an account that what currency you're borrowing in. You have to make sure that you're borrowing in US dollars, so you get repaid in US dollars, assuming that that's your currency of choice that you think is going to be most stable or preserve its value the best. So in real estate, you could also be a little bit risky. You could buy individual properties in hot areas to try to bank on potential asset appreciation. You could rent out those properties, takes a little bit extra work, or you could hire a manager to rent the properties out for you, or you could just buy real estate trusts, or you can buy REITs that you think will do better than the rest of them. Perhaps you have one or two in mind that you have some kind of insight on that you think will do better, and so you just buy those one or two names instead of a basket of real estate investment opportunities like trusts or individual properties. And then commodities, if you just buy a commodity basket, you might spike. They tend to spike due to shortages, supply shortage, etc. However, over the very, very long term, they actually tend to decrease in value. If you look like a 100-year chart, you'll see how it's a slow trend down. I don't have the chart here on me right now, but maybe I'll do another video on that sometime later. However, if you have some kind of insight, perhaps we've just hit a short spike in deflationary period, and let's say silver goes under $10, well, you may want to put a large amount of money into silver at that point, because as the money starts flowing in again, by way of banks or central banks or government programs, that silver price is going to get bid up as the demand returns, as people have liquidity again in order to basically take their money off of the pawn shop. You can make kind of a safe bet that the price is going to return. Another good bet was during March of 2020. You could have bought oil when the futures prices went into the negative. I actually searched ways to buy oil during that time and actually couldn't find an instrument that I could profit off of except energy companies, which didn't actually get hit that hard. And I bought some energy companies and made a little bit of profit there. But anyway, you can buy commodities more like a trade rather than a long-term hold, unless perhaps you're holding gold and you want to protect your purchasing power against the inflationary pressures in cash and bonds. So those are some ways that you can de-risk your account. I hope you'll learn a little bit about this, trying to make an educational video instead of just updates of my account. If you want updates on the account, I'll be posting videos hopefully more regularly from now on, and I will show you how my account is doing. Or you can just go look back at the 350 videos I've already made, and you'll see all the evolution of the account that I'm doing, this public account, and trying to take it to 1 million. Alright, with that said, I want to end it right here. Hopefully you all learned something. Peace out.